So yeah, I think if we take the whole sector globally, it's clearly been a challenging couple of years. A combination of the rising interest rate environment, the geopolitical risk situation, which seems to be increasing. The question around how to go about then hedging that risk is more challenging. It depends on the asset. It depends on how the investor is set up, how the fund is set up.
Jackie, thank you very much for being here today. 700 people at the Europe GRI, and I invited you for this brief chat as I want to get your views on the market and on the opportunity that we have here. But before we go to the questions, can you give an overview about Chatham Financial Euro and your professional background?
Thanks very much for inviting me along. My name's Jackie Bowie. I'm the managing partner at Chatham Financial and head of the EMEA business. Chatham are a global independent capital advisory firm, and our focus is on risk management. So we help our real estate clients on thinking about how to hedge their interest rate risk, their foreign exchange risk. We're also a global technology provider on everything around debt management, debt valuations, and everything in the world of derivatives.
We are living in a world full of uncertainties, and there's not a single day that we don't come across with something new, something that probably brings a lot of challenges for the decision-making process of any company that wants to deploy capital in the real estate industry. Now, considering everything you see in the marketplace right now, which asset classes and regions you see as the most interesting, and which ones are the ones with more risk?
So yeah, I think if we take the whole sector globally, it's clearly been a challenging couple of years. A combination of the rising interest rate environment, the geopolitical risk situation, which seems to be increasing, and obviously then the impact on valuations across the entire asset class. But as we came into 2025, we really started to see more kind of bifurcation of underlying asset classes, and certainly the same with regions. One of the big trends in terms of global flows, real estate investors trying to decide which region to come into. And we've seen a really large increase in our clients asking us about how to think about US dollar risk, for example. So whilst they're obviously looking at the underlying asset class and they're looking at the geography in the region, they're now much more switched on to the fact that they might have US dollar foreign exchange risk. And the way the dollar has moved this year obviously reflects that. So it's difficult to say specifically it is an asset class. It's about data centers, it's about residential, because the answer is it depends on which region and what other risks then arise, particularly for a European investor who's much more exposed to currency risk than perhaps a domestic investor would be. So we're certainly seeing more indications that Asian investors focused on Europe, maybe moving away from the US, and domestic European investors also deploying more domestically and away from the US. And then within that, and we've heard this in the last few days at GRI, the themes have been really consistent in the breakout sessions around the sub-asset classes that look good. Some of the areas that look slightly spicy. Everyone's been talking about data centers and logistics for so long, but that still feels like an area people are focused on. But the one, little nugget of bright light that I've heard in the last few days is really a focus on retail, which we never thought we would hear that again. But again, subject to the underlying country that we're in as well.
Given ongoing foreign exchange volatility and cross-border capital flow, how should sponsors think about identifying, measuring, and managing currency risks from underwriting through exits?
Yeah, and I think that is really a big hot topic at the moment. As I say, because of the way the US dollar has moved and weakened versus kind of euro strengthening and GBP strengthening to some extent. And I think the first point, at the point of underwriting, it's certainly taking into account what the potential outcome would be under different currency scenarios. There's been a kind of long-term situation of, call it US exceptionalism, but US dollar strength. So probably less concern that the currency would be an issue. So at the point of underwriting, I'm certainly looking to see if I'm a euro investor in a dollar asset, what does that look like at exit as the dollar moves, and whether it moves up or down, but really doing some detailed sensitivity. The question around how to go about then hedging that risk is more challenging. It depends on the asset. It depends on how the investor is set up, how the fund is set up. But there are different products that can be used to hedge that risk. And very quickly, the inputs to that would be how long is my time horizon? How much liquidity do I have to support a hedge? And what rate do I want to protect it?
And beyond rates and foreign exchange, which emerging risks do you see rising for European real estate borrowers, and how is Chatham helping clients to build resilience across their capital structures?
Yeah, I mean, I said in my opening statements that, the increase in interest rates that we had through 22 and 23 really did take a lot of people by surprise. So they are then facing refinancing risk at much higher rates of interest. What then has happened, of course, is we moved into a rate cutting cycle. So ECB, Bank of England, the Fed, indicating that rate cuts were likely to come. The challenge that real estate investors have had is that those rate cuts, particularly in the UK and the US, have not been as much as the market was pricing in and have been further out in time. And again, the GRI commentary in the last few days, we've heard people talk about this emerging risk again of interest rates going back up from a European perspective. So if the ECB are finished with their rate cutting, and in fact, where we look at where yields are, so in the UK, the US, and again in Europe, medium to long-term bond yields are rising. I think the biggest single question around risk is the refinancing risk again is potentially at higher rates than people were assuming. So this rate cutting cycle we've had it's been a very short cycle, and already we're starting to talk about higher rates. So Chatham are helping their clients think about that to say, how can we take advantage? Because the forward curves are still pricing in rate cuts. Should we be taking advantage of that now by putting in place new fixed rate debt or new hedging? Because the chances are those rates are going to rise.
Now, let's talk about technology, artificial intelligence. This is probably something that you are considering, studying, implementing. How are you integrating artificial intelligence and the new technologies into what you guys do as a service and as a way to assist your clients and partners?
Well, our technology platform really straddles everything from the asset management side all the way through to the debt management and the hedging management. And if I wind back 5 years, the real push was for our clients just to have the data. They just wanted the information on their portfolio. And it was mainly like for reporting purposes. If we fast forward to today, the use of the Chatham's platforms is much more focused on dynamic decision making, which means not only does the data need to be consistent, accurate, and up to date, but it has to be accessible and used to make decisions very quickly. So that means, for example, as soon as a new financing is put in place for a new asset, that financing, the documentation, the economics have to be reflected onto the platform immediately, not a week later, not 2 weeks later, but immediately. And that's where AI can come into play. Just the ability to scan those documents, get all the economics onto the system. There's still a human pair of eyes, like checking that it's accurate. And what we're seeing is much more centralization, particularly with global sponsors looking to have access to their global portfolio in one place. And that's everything from, their leases, their occupiers, the economics of their debt, their bank relationships, all together from a global perspective, and not just looking at it region by region. And that is a huge lift. It's a huge lift. But I really feel, as I say, in the last 5 years, it feels we've done more in the last 5 years than we had in the prior kind of 20. So there's definitely a momentum and an acceleration behind it.
Jackie, a final question. You have been at the GRI here at this event, and you know us from before. Why did you join the GRI, and what's the benefit of being here?
Whilst we're all in the market every day and we think we know everything that's going on, it's not till you come to GRI events and have a chance to really have both formal and informal meetings. And I'm emphasizing the informal meetings because people are very open, people are very happy to share views because they feel they're in a more relaxed environment. I think the breakout sessions are great for determining themes and helping us understand what are our clients thinking about, what's happening in the market that maybe we weren't seeing. But then outside of that, as I say, the informal gatherings and the ability to set up one-to-one meetings in an informal environment is when you get the real nuggets of information of what people are thinking about for the rest of the year and beyond. So yeah, that's what I've got out of it so far.